when you look at your 401ks, you mentioned, your 401ks, and those type of investments, they were built for accumulation. That's what they were really designed for. They are not built for distribution. And let me explain why. Welcome to the Live Greater View, a financial planning podcast produced by VLP Financial Advisors that discusses life, money, and perspective. We help clients live their best life at every stage through our VLP Live Greater partnership process. Thank you for tuning in. All right, welcome back. My name is Rose Price. I'm one of the partners and financial planners here at VLP Financial Advisors. I'm also a certified financial planner.
And I'm Chris Malone. I'm a partner and financial advisor at VLP. I'm a certified financial planner and chartered financial analyst.
Great. So today's topic is answering our audience questions. So we've asked clients if they had specific questions for podcasts that they'd like us to cover, and we got one. We'd like to thank Rick for his question on what are bonds? And this is something we were just talking about that comes up a lot.
Yeah, it's something that if you're not in the day-to-day of what we do, you can be at the peak in your field, but when it comes to bonds, they're very confusing. It's a big market. There's some different relationships that we'll talk about today. So you're not the only one if you're looking at bonds and saying, hey, I don't get it. Stocks are fine, but bonds, you have a lot of question marks.
But with our recent volatility that we're seeing, we're filming this in early April, and we've got a lot of volatility with the tariffs. This is the time that people are going, now I understand why I own bonds.
Yeah, and it hasn't been that way, for the better part of the last 10 years with the bull market that we've had. So we're starting to see correlations really get back to basics, and a great time for bonds.
All right, so let's kick it off. So let's first talk about what a bond is. It is a fixed income instrument. So one of the things, and what does that mean? It's an investment that pays fixed payments, and in this case, interest. And in some cases, we'll talk a little bit, in most bonds, historically, they paid a fixed amount, and that was called the coupon rate. And a little history on the coupon rate. Why is it? This is what most people refer to as the interest rate. But back in the day, when they first started, the bonds actually had coupons, and you ripped them off and took them down to the bank to get interest.
The paper, old school.
Yeah, the paper, old school. So, they're fixed instruments, which means that you're going to lend money to a corporation or a government, and we'll talk about how that works. And then they're going to pay you a stated amount of interest over a stated amount of time. For some bonds, that could be 10, 15, or 30 years. And at that point, when the bond matures, you get back everything, your principal. So, Chris, why don't you walk through kind of an example?
Yeah, sure. So let's take a corporate bond, for example. So you would say, hey, I have $100,000. I'm going to enter into an agreement for 5 years. And you would lend them that $100,000. That corporation would say, well, to borrow that money from you, I need to pay you some sort of interest rate to really compensate you for the risk that you're taking for the time that you're letting us use this money. Let's say that they pay 5%. Over that 5-year period, they'll pay you 5% per year, typically in monthly or quarterly increments.
Yep.
Then at the end of that 5 years, they'll pay you your $100,000 back. So
that's the goal.
That's the goal. And you'll collect 5%. You'll get your $100,000 back. That is really meant to be an analysis that's standalone. Hey, is this worth the risk that I'm taking that I'll collect this interest relative to all of my other options, and then inevitably get that $100,000 back.
Great. So let's talk a little bit. I think what a lot of people get confused about is why bond values will go up and down.
Yeah. So if we think about stocks, stocks are really built on stories. They're built on narratives. They're built on, hey, I'm going to invest in this company. If it does well, that stock price will go up and my portfolio will go up. Bonds have an inverse relationship that says, hey, if interest rates go up, bond prices actually go down.
Yep.
If interest rates go down, bond prices actually go up. So that is something where you really have to really put the shoe on the other foot when it comes from stocks versus bonds. And it's something that gets lost in translation when it's discussed in the media and doesn't get a lot of airtime.
Yeah, and I think the example I use a lot with clients is, say, for example, you loan $100,000 to whether it's a government or a corporation, and you're getting that 5% interest, right? And that's what the market's paying. Because typically when you buy the bond, they set that rate based on what the current market is. So if the current market's paying 5% on a 10-year bond, for example, that's typically where they set it. Mm-hmm. But let's say you have changes in the environment, right? Inflation, there's other things that go into play. But now the current market's paying 6%. So if you wanted to sell your bond and we have to price that to the market, No one, who's going to give you $100,000 to earn 5% when they can go to the market and get a 6% bond? So to do that, what happens is the price, your $100,000 bond now gets valued somewhere less than that. So the rate correlates with that 6% market. Now, if you hold the bond to maturity, you don't really care about this, right? You could see this intraday. And as Chris explained, you collect your interest. At the end, you get back the principal. But if you are maybe needed to sell it for whatever reason, or you see interest rates go down, for example, and your 5% bond, and they're at 3, well, your bond now becomes more valuable.
Right. And I think that when we look at the overall landscape, the question marks that we always get is, well, what drives interest rates? And that's, there are a number of things that go into that question. But really the two main drivers are going to be inflation and growth expectations. So the reason why bonds are not correlated with stocks is typically when we have some sort of sell-off in the equity market, like we're going through now, growth is being questioned. And essentially everybody's looking at each other saying, hey, is growth really going to slow down? Are we going to go into a recession? And then all of a sudden interest rates start to go down because those growth expectations come down.
Right. So that's one of the reasons, again. So if you have that bond, and depending on, and we'll talk difference later between owning an individual bond and a basket of bonds, that can really, you could see that price be a little bit more fluctuating than, if you just owned a single bond, or even the money market where you see just $1 flat.
Yeah, and I think that your example of, hey, what am I making today in the market versus what did I buy that at? That is a very simple way to look at it. It's the best way to look at it because that will really make sure that you're really looking at where interest rates are going to go relative to where the market is and what your bond is actually worth at that time.
Yeah. All right. Well, let's shoot over to bond categories. So there really are 4 primary categories of bonds sold in the market. Chris, why don't you walk us through those?
The first one of the biggest ones is corporate bonds. So that is corporations. We can't name individual companies, but we'll think about blue chip companies that are all household names where they say, hey, you know what? I'm going to go out to the marketplace and lend the market money. Within corporate bonds, really important to delineate, there are investment grade corporate bonds, really good companies that you say, hey, I lend my money to them because I think I'm going to get it back.
Right.
And then there are other parts of that market, mainly high yield or junk debt parts of that market. Those are going to be smaller companies, more speculative companies.
Or could be companies, to put in perspective, could be companies that filed for bankruptcy and are trying to come out of bankruptcy. So they may go to the market to say, hey, we need to restructure our debt. We're going to issue new bonds to do that. And you have to think about, well, giving money to a company in bankruptcy versus I'm giving to this highly rated company that has good cash flow. And the delta is, though, you can earn more interest, right? I use the analogy a lot with, it's kind of like when you go to get a car, you got to get a loan for your car, right? If you have great credit, you walk in, they'll go, no problem. Some cases, 0.9% financing. But if you walk in and you have bad credit, they go, well, there's 2 places that might lend to you, and it's 24%. So that's kind of the same same scenario when it comes to corporate bonds, also.
Yeah, and that's something where we say, hey, if you're looking at a bond and you're seeing a blue chip company that's yielding, let's say 5%, and all of a sudden here comes bond number 2 that's yielding 9-10%.
Yeah, look under the hood.
Yeah, if it sounds too good to be true, it probably is.
Yeah.
So just be aware of that, when you're looking at yields and just thinking, hey, if I connect the dots and buy this bond for a higher yield, you're taking on additional risk.
Absolutely. All right, let's move over to municipal bonds.
So this is a whole separate category of the bond market driven by states and municipalities. The big benefit of this is interest that's collected is tax-free as long as it's paid on the state that you live in. And that's something that when we're constructing portfolios, whether they're retirement accounts or non-retirement accounts, a big factor that we take into place.
Yeah, so for municipal bonds, they're always federally tax-free, the income. But if you buy a bond, like you live in a state of Virginia and you buy a California bond, you can't deduct the interest in the state unless it's the same state. But municipals, again, opened by states and municipalities, so you do get that additional tax deduction.
Mm-hmm. And the next category, government bonds. This is the plain vanilla part of the bond market. Government bonds have different term structures. The most prevalent one is the 10-year treasury. So that is the yield that's most quoted, typically in the media. This is the most secure part of the bond market. So if we think about bonds on a spectrum of a lot of risk versus the least risk. Government bonds are on the low end of the spectrum.
Yeah, I always say, the government has something that companies and municipalities don't have, and they own a printing press. So they can always print more money. And so, again, it comes down to making sure that government, because it could not just be the U.S. government, that you can have bonds in foreign governments. You do want to know what is the likelihood that they can pay that back also.
Yeah, and the last sector of the bond market that's most prevalent are mortgages or mortgage-backed securities. That is a part of the bond market that tended to get a bit of a bad rap, obviously after the
2008.
the financial crisis. Yeah. That's when that went from being a pretty unknown part of the market to front page of the news. When we look at that today, this has changed dramatically since then. This actually is one of the higher quality parts of the bond market. And if you think about it as far as, well, government bonds are really risk-free. Then we look at mortgage-backed securities. That is really the second layer on the risk scale. And if you think about, well, people will probably default on a lot of things before they default on their house. And that's the way that the market tends to price these bonds.
Yeah, and so that's a good point. You brought up mortgage-backed, securities, and just to give a little bit clarification, that's obviously your house is the asset that is tied to that mortgage. So if something happens, unfortunately, we've heard it happen. 2008, we saw a lot of it where properties get repossessed, and there is still some value there, but it's backed again by something other than just the promise to pay.
Yeah, and when we think about all four of those different parts of the bond market, typically, just like on the stock side of the ledger, something that's diversified would include all different parts of the market in most cases. Yeah,
absolutely. And we could talk a little about that when we get down to some of the type of bonds we deploy here at the company. All right, so let's talk about why bonds are issued. We touched on a little bit, but let's run through kind of the four primary there.
Yeah, so really the main reason is just to provide financing for ongoing operations. When companies are looking at what they have on the table as far as options, they could either issue equity in their business. That's something that has a lot of different strings attached to it. That's really complicated. That's really something that's just tabled for the most part. And then when they look at this side of the ledger, they say, well, I'll go out and I'll issue bonds, agree to pay back at a certain interest rate, and essentially that gives them the cash for their operations.
Yep. Another option is financing debt. So again, we talked a little about maybe you're restructuring, building, or there's some new position, something they're building out in the company that they want to finance that specifically for. So that's an option that we typically see where companies will issue there, or even municipalities.
Yeah, and that's really the last big purpose of fixed income or bonds is, if you're a corporation, you need capital investments. You can issue bonds to buy machinery, equipment, certain research and development projects. If you're a municipality, you can do that to reinvest in schools, hospitals, infrastructure. So it's just saying, well, we really think that this project is worth undertaking. How are we going to get the money to make that happen?
Yeah, and most of us, especially if you vote in your local municipalities, you've seen at some point on your docket, do you approve this bond to build this new school or these new highways or this infrastructure? And that's really what we're talking about. They're issuing a bond, in some cases, those numbers will be pretty big on your ballot, $100 million, $200 million. And they're hoping to pay that back in either from taxes that they're going to collect, or in some cases, there's the revenue bonds. So, for example, maybe they build a stadium, and that stadium is going to house a professional team or other events, and then they're going to take that revenue to pay it down. So, again, these are different aspects we look at to say, what is really the risk profile of the bonds, and what is the likelihood that we're going to get the interest and we're going to get principal back?
Right. Great. Well, let's pivot to one of the most important pieces of our conversation. That's why hold bonds.
Yep.
Let's unpack your thoughts on that, especially relative to the current environment.
Yeah. So, if you're in the accumulation phase and you're not in the need to take income or generate distributions, then you probably don't need a lot in bonds, right? Because your goal is to grow those investments as much as you can in the period of time until you need them. But when you get to that distribution and income phase, it's a little bit different. We're all ingrained, save. And then what we see when clients get to this point where they go, all right, now how does this all work? Like, I've put all this money in here, and now how do I get it back? And how do I not run out of money? And I don't have a paycheck. So, the bond side of the equation gives us a couple things. One, when you have market volatility like we're experiencing this year, it gives you a position in the portfolio that usually doesn't correlate with the market and is up, right? So if you need income, it gives that interest payment, right? If you have a bond paying 4%, 5%, whatever it is, maybe you own some high yield, that interest will go to replenish the cash that we'll use for distributions and income. So you might want that piece in there. And then the other big piece it's again, that volatility. If we have markets that are down, and let's say they're down 15, 20%, or just even any position in your portfolio, you don't want to sell those positions, right? You want to be able to go and take from other positions that are positive, right? So if your bonds are up, you sell bonds there. If the market's doing great, you sell positions because in your stock portfolio. Because when you have the market down, you have to sell more shares of your stocks to get that income. And it also gives you the ability to let that position to continue to grow and come back because, with inflation, we want to be able to keep up and be ahead.
And when you think about somebody that's worked for 40 years, they cross, the bridge to retirement, and they're not as familiar with the portfolio construction piece and, hey, how do I convert this 401k or this investment into my daily life and use that to fund, my expenses? Bonds are the most important piece of that distribution strategy. And we want to make sure that we have enough in bonds to get us through any sort of material drawdown.
Yep.
If we look historically at really bad drawdowns that we've had, if we think about the dot-com bubble, the financial crisis, these periods where we really go through a bad bear market, the underwater period, meaning where we hit a high in the market, sell off, and then we remain underwater on the stock side, that typically lasts between 5 to 7 years.
Yeah.
So our analogy is we want to make sure that we have at least 5 to 7 years worth of distribution needs in bonds and really let that be our North Star for guiding what the overall asset allocation should be of the portfolio.
Yeah, and the other benefit it gives you is you now have something typically when you have a market pullback that's positive. And if we really say, hey, wow, we've hit this, we think we're close to the bottom. No one ever really knows when you're there. You always think, and then the market gets a little choppy. But it gives you the ability to say, hey, stocks look very attractive. We can actually sell and rebalance. And if you can do those things, that should allow you to recover faster because you are buying stocks at a lower cost. And as it comes up, it should give you you participate more in that recovery. So it definitely is it's a great position and mainstay in our portfolios for those who are at the retirement, the income phase. And also, the difference is we talk a lot with clients is, when you look at your 401ks, you mentioned, your 401ks, and those type of investments, they're great they were built for accumulation. That's what they were really designed for. They are not built for distribution. And let me explain why. Because on the 401k side of things, if you in a market where you have a lot of volatility and you need to get your monthly distribution, quarterly, whatever that is, you can't pick and choose where to sell from. So in a scenario where the stock market's down 15, 20% and bonds are up or flat, it sells across the portfolio. So it's going to sell shares of your stocks that are down. It's going to sell some of your bonds. But the reality is you're not having that ability to pick and choose and help the longevity of the portfolio.
And I also think from a behavioral perspective, knowing how much money you should have in this bond portion helps in good times and bad times, because what we've seen in our industry is typically if we're trying to figure out, well, how much risk should someone be taking, our industry will hand them a questionnaire and say, how do you feel about the market? How do you feel about fluctuations? And that questionnaire will be answered based on what's happened in the last 6 months.
Yes.
So
it's very relative.
Having some sort of formula, something that's based on expenses, based on math to back into how much we should have in bonds, that can really let you cut through a lot of the noise that you see in the media and allow you to just think more about the long term.
And reducing anxiety. I was just at an event last night and with a lot of different people, and they ask, "Oh, what do you do?" I'm a financial planner. They go, "Oh, I bet your phones are ringing off the hook." We're like, "No, not really," because for our clients, they understand the strategy. And when, in this perfect example, at the beginning of the year, the markets have been really great the last 2 years for our clients taking distributions. We raised cash and rebalanced. So when the market gets volatile, we're not worried where their distribution's coming from or how it's going to affect their longevity because we have this built-in capacity. And it also gives us that flexibility. Again, as we talked about, if we do see a point where we say, hey, things are starting to look inexpensive on the equity side, we have the ability to do something without having to call the client and say, hey, send more cash.
Right. So opportunistic.
Yeah. So it's very opportunistic. So bonds certainly, the great part about it is, for your income and for the portfolio, when you have that volatility period, it gives you that stability.
Awesome. And I know that we alluded to before about the importance of credit quality. I just want to bring that back into this distribution strategy phase, because that whole process of us going through distributions from something that's stable, that does not work if bonds are down as much as stocks.
Yes.
And that can only happen if you own only junk bonds, bonds that are yielding 9-10%. That's great when we're in a bull market. Then we're in a bear market. That doesn't work.
Yeah. So same thing. When you think about your bond portfolio, it should be diversified just like your equity portfolio. You should have some high grade quality, short term potentially if you are taking income, just depending on where the market is and what rates are doing. And let's talk a little bit about how short, intermediate, and long term bonds work in a fluctuating rate cycle.
Yeah, so if we think about rates going up or down, that is obviously going to move, as we talked about, inversely to prices of bonds. How sensitive bonds move relative to those, relative to rates moving, that's going to depend on how far out your duration is. So if you have a bond that's a year in maturity and rates go up or down, that bond's really not going to be impacted.
No.
If you have a bond that's 5-10 years out, then that's really going to be impacted.
Right.
So it's almost like you're dialing up that lever for sensitivity to interest rates based on how short in duration or how long in duration your bonds are.
Yeah. So duration, just give a little background. Duration is how long will this bond be around? When will it mature? So if you own a bond in our early example that you paid $1,000 for or $100,000 for, and it's supposed to mature in 6 months or a year, the likelihood that you're going to get, you're much closer to that, getting that 100,000 back, right? Whether the market does, because the maturity and duration period is going to end. But if you are 10, 15 years out, well, it's just kind of like the stock market. You don't know what this company is going to do 10 to 15 years out and where interest rates are going to go. So there's a lot more volatility in, hey, what will that rate be between now and then? And will I get back my 100,000 I put in? So, the closer you are, the shorter the duration, the less volatility. But if you have a 30-year bond, that could be a wild ride. Again, if you're owning it just to collect the interest, then it really doesn't affect you because you're going to get that interest and hopefully you're going to get that money back in that 30-year period. And if you were lucky enough to own any bonds bought in the 80s with 14, 16% interest rates, we haven't seen those. You didn't want that bond to mature.
Right. That was a point in time, and I don't know if it's coming back anytime soon.
Chris wasn't even born.
Yeah, that must have been the days. Yeah. Well, one other minor point that has come up over the years in meetings is this concept of the difference between individual bonds and bond funds. I thought that it would be good for us to spend a minute or two talking about pros and cons and just why our typical preferences for a fund at this point.
Yeah, unless you have a multi-million-dollar bond portfolio, it's a little bit more expensive for you to go out and buy the individual bonds. You can build a bond ladder. There's cost in that. There's maturity. There's a lot more intensive work. And the way the bonds are sold, they like to sell them in these 100,000 or higher lots, right? So it gets a little inefficient if you only have like a $300,000-$400,000 need for bonds. The nice thing from our perspective also is using managers is that you're getting expertise there, just like we like it on the stock side. And a couple of the areas that we really feel that active management makes a lot of sense is the bond side and the international. And we can see that. And how do you know that? We look at our managers and they're outperforming the index. So when they're adding value, after their fee, that's really when you want to own them. But it's also the ability, like some of the funds that we use are what they call multi-sector or strategic bonds. So instead of, for clients who maybe only have a $200,000-$300,000 portfolio in the bond side, they can go out and decide how much do they want to have in potential high yield or floating rate. When do they want to go intermediate short? So it allows diversification and active management. It also reduces your risk because you're not just worried about one bond defaulting, these can own anywhere from a couple hundred to thousands of bonds in these positions.
Yeah, and I think from a issuer standpoint, if you're a big corporation or government, when you go out to the market and you say, hey, I have a couple $100 million in some instances of bonds, they go to the primary dealers and these fund companies that we own, big institutions, and then essentially after those issues are filled, then everything else kind of flows through to these other segments of the market, and retail being, one of the last segments. Typically, if you're pulling up in a brokerage account, hey, what's this individual bond?
Yeah.
It's going to be the bottom of the barrel in most cases. And it's just, reality for how that process works. Also, the liquidity aspect of it as far as, well, what am I leaving on the table if I actually need some of that money as a big deal?
Yeah, and that's a great point. So if you own an individual bond, and let's say in the example we used earlier, where you're getting paid 4%, now the market's paying 5%, and you need money, you're not going to get that 100. You're going to get a lower value than your current bond face. So you put 100,000 in, and maybe you're going to get 92,000 back. So it just really depends on where things are. Versus your bond fund, again, diversification, all kinds of different bonds bundled in there. You can sell that, in likelihood, you may or may not have any loss built in, but because it's a bundle of different investments, you have a little bit more flexibility.
Right.
In cost, it's cheaper to trade.
Right.
Yeah, a lot more. Yeah.
Awesome. Well, that was great. I know, the equity side is fun to talk about, hear stories and narratives and whatnot, but you can see the bond side, there really is an art to it, and it affects so many different parts of not only the portfolio, but planning and how it fits into the big picture.
Yeah. And if you have any additional questions or want to talk specifically about, what you own and why we own it, hopefully we usually explain that, but happy to review and give you a discussion. Or if you're at that point where, hey, I've been in an all equity portfolio, I'm listening to this podcast and wonder, should I be making adjustments? Feel free to reach out. We'd love to talk to you and see how we might be able to help.
And as always, we ask that you please pass this along to family and friends if you found this to be helpful. And thank you for tuning in.
Thank you for listening to this episode of the Live Great Review. If you like what you heard, please subscribe to our podcast on iTunes or Spotify and recommend our podcast to family and friends. To learn more about VLP Financial Advisors, please check out our website at vlpfa.com. Thanks again.
And now for our necessary disclosures. Securities and advisor services offered through Cetera Advisor Networks, LLC, member FINRA SIPC, a broker-dealer and registered investment advisor. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned. Due to the volatility with the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results.